Good morning, good morning, good morning, good morning. I hope you guys are having a jolly season. Today, we'll be adding two more pieces to the puzzle, to our thesis that in a couple of months, we will be approaching the rising bull market phase. We'll be talking about Bitcoin on the monthly time frame. I found something really cool with the stochastics and the cycles lining up perfectly. But first, we'll be talking about the FOMC meeting coming up in Feb, the 1st of Feb. Yes, it's going to be very important, and it's playing a pivotal piece of the puzzle. And this discussion over here is going to play a pivotal role in adding confluence to our thesis, because this bar graph along with this table together is indicating a possible end to the rate hiking cycle. Alrighty, let's begin with the Fed Watch tool, target rate probabilities for Feb 1st. Now, for those of you who are new here, don't let this chart intimidate you. I'm going to explain everything that's going on over here. And by the end of the video, you're going to be saying, damn, that's actually very simple and very powerful. And those of you who have been following, we have something really interesting going on over here, something that's going to set us up for the next bull run. So you do want to be paying attention. So let's go ahead and begin what's going on over here. At the moment, our current target rate, right, the Fed's target rate is sitting at 425 to 450. Now, this target rate over here is a jump up from the previous target rate, which was 375 to 400. And if you guys do remember, in the previous FOMC meeting, the Fed increased rates by 50 basis points, right? So when you increase rates by 50 basis points, you add it to what we previously had, which was 375, and you get the new target rate of 425 to 450. And what does this mean? What does 425 to 450 really mean? All it means, guys, is that the Fed is now going to be targeting an interest rate of 4.25% to 4.5%. All right? It's as simple as that. So this is the new targeted interest rate on the front end. Now, here's where things get really interesting. We've been watching this Fed Watch tool for a while now, and we've been keeping an eye on what the market is pricing in for the next increase of the Fed meeting, right? The next Fed meeting is coming in on Feb 1st, okay? Feb 1st. So we have around 6 weeks to go for that meeting. If you look at this bar graph over here, what it's telling you is what the market thinks the probability of the next target rate is going to be, right? So at the moment, the market thinks that there's a 69% chance that the new target rate is going to be 450 to 475. Now that's really interesting. Why? Because if you take the current target rate, right, and subtract it from this, you're going to see that that's going to be an increase of only 25 basis points. Now that is a massive change compared to what we've recently been seeing for the past months and months, where the Fed has been increasing by 75, and most recently, the Fed increased rates by only 50 basis points. And now the market is saying that in the next meeting coming up Feb 1st, the Fed is going to increase the target rate by only 25 basis points. So what we are seeing over here is a massive potential change in the rate of change of the hiking cycle, right? Because if you guys think about it, for the longest time, the Fed kept the target rate at a relatively low and stable rate of around 0 to 0.25%. So if you have to kind of draw it out on a graph, it looks something like this, right? Where you're going flat to 0, and then suddenly the Fed started increasing rates aggressively, right? 75. And now, last month, we saw an increase of 50. And now the market's saying that the next month after that in Feb is going to be 25. So compared to this rate of change over here, which really wrecked the markets, right? Especially growth. And you guys know that I consider Bitcoin to come underneath that growth criteria under technology. So we are seeing, compared to this rate hike cycle over here, which was really aggressive, a change in pace, a change in the rate of change of the hiking cycle. And I've told you guys this before. It's not really the nominal number that matters, but it's the relative number. It's the rate of change. You're going to hear a lot of people from the previous generation saying that, hey, 4.25 interest rates, that's nothing. I've seen target rates of around 10%, 15%. But guys, what really matters is how fast we've changed and from how low we've come. And we've come from a 0% interest rate and we've gone all the way up to 4.25. That was aggressive. That hurt the markets. Now, similarly, we are going from 75, 75, 75, decreased to 50, and the market got really excited about that. And now we decreased down to 25. The market is like, whoa, that's bullish. It's a bit ridiculous to think that a rate hike is going to be considered bullish. But again, it's relative to what the market was expecting and pricing in. And if you go and look at this table right over here, guys, okay, 1 month ago, right here on this column, it is showing you what the market thought the rate hikes were going to be 1 month ago come this time, right? So 1 month ago, the market was pricing in a probability of 50%, more than 50% actually, that we would be sitting at 475 to 500 basis points, which would have entailed, guys, a 50 basis points hike again at the very least. In fact, there was a probability of a 500 to 525, which would have meant a 75 basis points hike, right? This kept decreasing and decreasing as we got closer to December. And the reason for that is because the economic data kept coming in softer and softer and softer, right? The LEIs, guys, which stands for leading economic indicators, have been coming in very weak, which is pointing to a potential recession. Now, all of this is lining up with a discussion that we've been having in Discord, right? Julian posted saying that some of the market commentators that he really respects, and I respect these guys too, they've been saying that the Fed might be done. The Fed may not even increase anymore whatsoever. That they are saying that the most recent rate hike of 50 basis points might be it. That we may not even get a 25 basis points hike. Now, as things stand, the market is saying that we will get at least a 25 basis points hike, right? There's a 70% probability that we get a 25 basis points hike coming in Feb. But hey, a lot can change in 6 weeks. Again, look, only a month ago, the market thought that there'd be a 50% probability of a 50 basis points hike, right? Like we'd be at a higher target rate come Feb. Now, however, the market is saying, we don't know about that. We actually think that we are going to get only a 25 basis points hike. And this is going to be a softening. What if we actually get a 0 basis points hike, right? That's at the moment, as things stand, I'm not looking for this, right? I want to see a little bit more indication, a little bit more of the LEI softening to get convinced that the Fed will really change their mind and go from a rate hiking cycle to a flattening. And in my opinion, they're going to be looking to increase for as long as they can, even if it is one more time or a couple more times. They're going to try to increase as long as the leading indicators, right, leading economic indicators allow them to do so. And the big one, guys, that I've been keeping an eye on is the jobs reports, right? If you look at the jobs data, the labor market, I've talked about this in previous videos on Mango over here. The job market is what's allowing the Fed to increase interest rates regardless of everything else, because at the moment PMIs are coming down, right? But the labor market is still tight. Because as long as unemployment is low, the Fed is going to have that wiggle room. It's going to have that excuse to increase interest rates regardless of the other LEIs, right? As soon as they get their target unemployment rate, and yes, they are targeting a unemployment rate because that is going to affect demand, right? You bring unemployment up, demand is going to come down. Now, unemployment has been ticking up slowly, and as soon as we do get the next unemployment report, that might be enough. That might be enough for the Fed to say, okay, you know what, we're going to stop here, right? We won't even be doing 25 basis points. We're going to pause, right? That's what they're going to say. They're going to say we're going to pause and we're going to see how things go. Because as things stand, a lot of commentators are saying that the market is already in recession, and if not, we are going to be looking to get into a recession very soon. So the market is clearly expecting a turn in the rate hiking cycle. At the very least, least we're going to be slowing down, right? So looking for a 25 basis points hike, but we could also be seeing a 0 basis points hike. The big question is, how far do they go? How far will the terminal rate be, right? When I say terminal rate, guys, it's the end of the hiking cycle. What's the highest the Fed will go before they stop, right? We've drawn this graph over here, right, where we're showing it slowing down, but where do they stop before we start seeing it coming down? That's the big question. And what does the market think? Well, we actually have that data as well. All we have to do is look at the Fed fund futures, which, to quickly explain, is simply a interest rate market where the market hedges against rises and falls in interest rates, right? So by looking at this data over here, guys, we can look forward into what the market thinks is going to happen, right? We can get a implied terminal rate. And the data I have over here for you guys is going from December 2022, which is essentially today, all the way down to December 2023. So I have 1 year's worth of data for you guys. And if you go ahead and calculate the derived implied terminal rate over here, you are seeing that the market thinks that if we're going to top out around May to June 2023 before we start seeing a decrease in the target rate, right? So to reiterate, the market thinks that we are going to be increasing rates all the way up to May and June. But how much? How much? Well, the implied terminal rate here, guys, by the way, to quickly calculate this, all you do is take 100 and subtract it from the number you are seeing over here. So 100 minus 95.115 gets you around 4.885, right? So 4.885, which if you round up, gives you 4.89%. So 4.89% is what the market thinks that we're going to be at come May, June. Okay? Remember, 4.89% come May, June. But what does the market think that we're going to be at come Feb? Right over here, remember? We were talking about that just up here. Over here, we saw that come Feb, the market is pricing in a 70% probability that we are sitting at a 450 to 475. So let's go back down. Okay, we're going to write that down over here. 450 to 475, right? Which essentially means a 4.5% to 4.75% target rate for Feb. So what the market is saying in the entirety, if you look at this chart over here and this table over here, what it's saying is that between Feb to June, we are going to be moving from 4.75 to 4.89%, which means that between Feb and June, the Fed is expected to have only a 25 basis points hike. And by the way, 4.89% over here on the Fed fund futures is essentially the midpoint between 475 to 500, right? So when you look at it this way, guys, this is the target, the implied target rate for May/June. And this over here, 450 to 475, is the implied target rate for Feb, right? So again, from Feb to June, only 25 basis points, which means that according to the market, the Fed will be slowing down and topping out by June, and from then onwards, they are going to be expecting lower target rates, right? Now, we don't know if that's going to come true or not. So this is the current market expectation, okay? It's really, really important for you guys to understand what the current market expectation is, because any change in behavior from this expectation is either going to cause a push in the market or a downside in the market, right? So a push up will happen if all of this data starts moving upwards, right? So essentially, if the market says, hey, we're not going to be topping out May or June, we might be topping out all the way in Feb, March instead, right? If we start topping out in Feb, March, that's going to be bullish. But instead, if the opposite happens and the market starts saying, hey, you know what? Inflation is back on the cards. We need to wipe out inflation again. We are going to top out only all the way in September, October. Well, that's going to be bearish. So what's really important is that at the moment, the market thinks that we're going to be topping out May, June, and that we are slowing down, okay? Slowing down to around 25 to 25, and we're topping out May, June. What if the opposite happens? What if we top out early, or what if we top out later? Well, if we top out earlier, well, that's going to be relatively bullish. Again, it's still going to take time for the risk markets to start turning around. But first, your bond market is going to turn around. Your fixed income market is going to turn around. They are going to start going up. Then after that, your risk assets like NASDAQ, Bitcoin, etc. are going to go up as well. And that actually allows us to segue really, really well into Bitcoin, because I do want to show you guys what I am noticing on the Bitcoin chart that happens literally only once every cycle. And this lines up with what we are seeing over here on the Fed Watch tool and the Fed Funds futures, that hey, in a month or so to come, couple of months, we are going to be seeing the bottom of this bear market. So with that, let's go ahead and switch on over to Bitcoin. Alrighty, and here we are looking at Bitcoin on the monthly time frame, right? And this is really, really interesting. And what we're going to be doing, guys, is we're going to be looking at our stochastics indicator. I'm not going to spend too much time today on the charts, because I did promise you guys I'm going to keep these videos as short as possible, but I do want to talk about what's going on over here. Now, quick disclaimer before we talk about the stochastics. One, do not ever use your momentum indicators as your sole indicator, especially using them as your oversold or your overbought indicators. You guys know my thoughts on that. Markets can stay oversold for a very, very long time and keep going down, oversold. And markets can stay overbought too for a very, very long time. A really good indication was the 2017 bull run. We stayed overbought for an entire year, leading from around $1,000 to $20,000. Yeah, so good luck trying to short that with your overbought call. But that being said, when used appropriately, the right time frames, along with other confluencing charts and indicators, it can be very powerful. And over the past months now, we've been putting together a story of multiple charts, multiple tools, even on-chain indicators to come up with the story that, hey, in a few months, Bitcoin might be bottoming out, right? And we said that a month ago. So we're approaching that area now. Around Febish, I've been talking about how we are going to be approaching that rising bull market stage of our matrix, right? So going back to the stochastics, what we are looking for over here, guys, okay, on your stochastics, let me go ahead and zoom in for you guys, okay? On the stochastics, you're looking for when the blue crosses above the red, okay? You want it to be underneath the 20 zone, okay, underneath the 20 zone, and the blue crossing over the red. And this has happened only 3 times now in Bitcoin's history, okay? Let's go ahead and mark out each of those areas. Right over here, okay, which was around June 2015. Then right over here, which is around April 2019, and then we don't have it yet. But if all things go well, we may get it if Bitcoin closes the month green. And I believe Bitcoin needs to close around 17,300 to close the month green. So the last time we got it was during the bottom of the 2019 bear market, right over there. We bottomed out, we rounded out, we closed the month green twice, and then got the nice cross, widened out, and saw the bull market rally, put in a higher low, and then the big up thrust, right? What happened over here, right? The one prior to 2019 was 2015, right? And what was Bitcoin's price? Around $240, right? So again, let's go ahead and zoom in to that price action. Again, it wasn't a straight up, guys. Don't expect a straight up, eh? And by the way, if you guys are enjoying this type of content, because I was really hesitant to talk about things like FOMC and Fed Funds futures, because a lot of people in crypto are not all that interested, but I'm hoping that the Mango community is interested in this. And if you guys are, please let me know in the comments down below, because it's really motivating to hear that you guys are interested in this type of content, because it takes a lot of effort to explain and break it all down for you guys. But that being said, let's go back to what we're talking about over here. Again, the last time this happened was 2015, right? 2015, and Bitcoin was sitting around $250. We got the cross, we got the push up, got the high low, and then the big bull market run. Now, keep in mind that the 2017 push up was a lot more aggressive than the 2015 push up and higher low, right? And I have a feeling that far too many people, including me, including us in this community, are going to be looking towards 2017's market to repeat, right? Recency bias will have us thinking that, you know what, we're going to have a big move to the upside, then a higher low, and then a continuation. But what if we get this, right? We have to keep that as a possibility too. We could get a small trudge up, something like this, right? So hey, who knows? That would actually entail a longer bull market as well. So that may take us to higher numbers if we don't get that the volatile move down, etc., etc. So, anyways, the main point over here, guys, is that the monthly stochastics, if they cross in the next month or two, could be another piece of the puzzle adding up to that rising bull market stage. Because the last two times this has happened, okay, we have had a massive move to the top of the stochastics channel, right? Each time we have gone up to the top. Now, back in 2012, we didn't have enough monthly data for the stochastics to actually cross. In fact, the stochastics started at the bottom right over here. I guess you could say that, right? Technically, if you look at the data, you could say that, hey, 2011 bull market started somewhere at the bottom and we pushed up. Yeah, one could make an argument for that because it does. I'm not going to look at this. But you could say that, hey, we have three data points: 2011, 2015, and 2019. And tree makes it a trend. And if you guys do notice, all of these crosses have happened 4 years apart, right? 2011, 2015, 4 years apart. 2015, 2019, 4 years apart. 2019 to 2023, 4 years apart. My oh my. So hey, is it time? Is it time for the next bull run in the next month or so? Things are adding up. We've been talking about multiple charts recently, and if you guys do want a summary of everything that we've been talking about, let me know in the comments down below, and I'll be happy to do a outline / summary of everything that we've been talking about so far, putting the story together. But those of you who have been following, hey, you guys know that it's getting exciting. I'll see you guys in the next video. I hope you guys enjoy this one. Ciao.